Meb, whose name is Mebane, but pronounced Mebin. Have I got that right, Meb?
Yeah.
I do know a little bit about you. He's the co-founder and CIO of Cambria Investment Management. He hosts a podcast. He's an author, notably of the Ivy Portfolio. I don't know if anybody can see this. This is shown in reverse. It's a fantastic book. It was written, I believe, in 2006, and it's timeless, not out of date. One of the things he covers, which is very relevant today, is tactical asset allocation. Wrote a brilliant paper on that. Al Zimslowski and I went up to San Francisco and covered that with that chapter back in the day. Meb is a frequent speaker, widely known and very much respected. He's a graduate of the University of Virginia, a double major in engineering science and biology. He offers a lot of great market wisdom and distributes it through his mailing list. He's a frequent guest on a broad variety of financial media. And I want to emphasize, he has a broad spectrum ETF family, and they're not Me Too ETFs. He also has a service for investing management. He's got 4 free books that you can find on the web, and they're great. The ETFs number, I believe it's 12. A tremendous source of investment knowledge and a great research guide for understanding the workings of the market. So without further ado, it's all yours, Meb.
Awesome. Well, thanks, y'all. I hold a special place in my heart for the AAII crew. We've done a lot of these over the years in all sorts of far-flung locales. A little weird to be doing this virtually, but it all works now. So it's good to see everyone in our boxes. Again, I'm going to talk for a little bit. I have no idea how long this will last, 20, 40, 60 minutes. We can take it slow. If you guys have questions, interrupt me in the chat or the Q&A, type in something. And then I'll stick around at the end. So this will be fun. You got to open your mind. Hopefully you've had a lot of coffee, because I speak slow usually on my podcast. You can crank me up to like 2 times speed, but today you have me in real life, real time. What are we going to talk about today? Talk a little bit about what's going on in the world. If you guys can see my screen, anyone that can identify this album cover. You guys remember when they used to have album covers, CD covers? Well, this was a cover of a album when I was growing up. Maybe I was in high school, I can't remember. Band called REM, and they had a really depressing, sad song called Everyone Hurts, Everybody Hurts. If you guys want to cry yourself to sleep later, you can look it up on YouTube. But it's going to be kind of a theme for the year so far here in 2022. We'll tell you why. We'll get it for everyone here in a minute. Again, the intro covered this, but I'll just give you all a heads up. My day job is managing Cambria. We're an ETF company mostly. We got 12 funds, about $1.5 billion, and over 125,000 investors, which sounds like a lot to me, but we love all of them equally. We publish some fun research once a week. If you sign up today, you'll get an email tomorrow from theideafarm.com. This used to cost you $500 a year, and now it's free. So that's pretty cool. It's one of the best action-packed emails you can get, I think, on the investing topic. You can watch me pick fights on Twitter. My blog has, I don't know, thousands of archived content. Again, we got the podcast with 400 or 500 episodes. There's been some real awesome ones lately. some incredible guests, and we got a few more queued up. So if you don't subscribe to the podcast, y'all check it out, share it with your friends. There's some really, really good ones coming up. And you can download most of our books for free now, either at Faber or at Cambria Investments. Usually you can find the free books, and they're ebooks, of course, but that's made mainly because I have a spat with Amazon and Jeff Bezos. We could talk about that later. All right. So I want you guys to think, and you're virtual, so you can be honest with yourselves, as opposed to if we were doing this in person, I'd make you raise your hands, which would feel a little more embarrassing. But given the fact that we're all in the same boat right now, 2022, here we are in September. Is your portfolio, is it up or down this year? Think to yourself, right? Okay, raise your hand in your mind. You can be honest. You can see these Twitter. When it shows me in the @MebFaber. That's my Twitter handle. I love to ask polls on Twitter because it gives the ability to answer things anonymously. Well, the good news is pretty much everyone's down. People said 80%. I think the 10 more percent were probably lying or clicked the wrong button. And why is that? Well, if you go to ETF.com or Morningstar, anywhere, and you screen ETFs, you take out the weird inverse and leverage ones, about 90% of ETFs are down on the year. 90. And so here's a big, and I think we circulated this. If you guys didn't get this PowerPoint deck, you can look at it later. There's gonna be a bunch of numbers and stuff, so you guys can review later, but just kind of listen, put your pen down. And why is that? Why is everyone down? Well, if you look on the left, year-to-date returns, pretty much everything's down. Bonds are down, stocks are down, foreign stocks are down, REITs are down, Bitcoin, I give that a LOL. Really, the only thing that's been up this year has been commodities, and not even all commodities. Commodities aren't just a asset class that is, just one thing. There's dozens of different types of commodities. Some are up, some are down. And what's the problem with that? Well, on the right side of this, if you look at the polls, well, what percentage of people own U.S. stocks? Well, everyone does. Again, 90% plus. And then, who owns commodities? Well, a minority does, right? So most people don't own any commodities. So most people have all the red stuff. So you're down. But good news is you don't have to feel too bad because everyone else is down. Everyone hurts, right? And that's part of this game we play. These markets, whether it's a single asset class, whether it's a strategy, whether it's your portfolio, we have an old post on the blog that we like called to be a good investor, you have to be a good loser. And what does that mean? Well, there's only two states for an asset. So think about S&P 500. Every day, it can either be at an all-time high or it can be some form of drawdown, right? And now it may only be 1% from all-time highs. It may be 20, 40, 60, 80% away from all-time highs. But there's nothing else. It's all-time highs or drawdown. And you spend about 70% of the time in some form of drawdown. Okay, so on an asset class or portfolio, majority of the time you were losing, you were down some amount. So to be a good investor, you have to learn to deal with these losses. And it's not something to run away from or to be scared about, but let's talk about it. Because a lot of people, what surprised them about 2022 is not that stocks are down. It's not that that bonds are down. It's that both are down at the same time. So it's been one of the worst starts ever for 60-40. These numbers obviously need to be updated whenever, but let's call it down somewhere in the teens. Bonds are getting whacked. But what the problem is, when you ask most people, you say, okay, how bad can it get for 60-40? And most people seem to think 0 to 20% is the biggest loss you've seen with 60-40. Most people in this poll answered 20 to 40%. 80% of people got this poll wrong because you lose over half at one point. Now think about that for a minute. You have a quote conservative portfolio. You're investing 60% stocks, 40% in bonds. You think that's meant to just kind of like chug along quietly, no big losses. But the reality is, in every country we've looked at around the world, 60-40 loses over half at some point. And I think that's hard for a lot of people to digest, right? So as they look at this year, they say, man, I'm down a bunch. 13%, 15%, whatever. Obviously, it can't get worse than this. Well, yeah, it can get a lot worse than this. And I think that's where a lot of the problems come with portfolios, relationships, coworkers, is when you have a mismatch between expectations and reality and outcome. And one of the biggest things you have to do as an investor is have a framework for understanding history. At least you know what has happened in the past, with the caveat that it can get worse, right? The biggest drawdown, worse returns are always in the future by definition. So just to kind of frame this, not to say we're going down 60%, but just to give you a little background of what has happened in the past. So, somebody, famous man, you ain't seen nothing yet. Possibly. Will it get better? Probably. But look at this. So this is a chart. All these gray squiggles are all the years of a 10-year period for 60/40 going back to 1954, but you could take this back to 1900, same difference. And you can see, there's a spectrum of future probabilities, what has happened in the past. Well, the green line was the latest 10-year period, one of the best, if not best, returns for 60/40 in the last 70 years, right? The blue line is the previous 10-year period before that. One of the most ironclad rules of markets is, this is very technical, so you might have to look this up later, but it says good times follow bad times often, and bad times follow good times, right? Global financial crisis, horrific. Guess what? Amazing returns after for traditional assets. Internet bubble burst, awful times followed by good times, on and on, right? That's just kind of how markets tend to work. And we had one of the best periods ever for US stocks and bonds. Bond yields darn near bottomed at zero for US government bonds. Remember, we were having that conversation for a while. Will US bond yields go negative? That was a long time ago. And in many cases around the world, they did go negative. And at the same time, US stocks romping and stomping, my God, since 2009, basically the best asset in the world. But like a party, you stay a little too late, drink too much champagne. What comes the next day? Well, it's probably going to be a hangover. So, and here's the problem with the good times. We spend a lot of time talking to investors, following the AAI sentiment polls, and people love to get sentiment wrong at the exact worst time. I mean, it's like out of a book. So these surveys, these companies, they do every year, and over the past 5 years, 7 years, you could see the sentiment just creeping up every year getting a little better. And to me, this really culminated in about February of 2021. You guys remember the meme stocks? Things were just going bananas. And what I'd like to highlight here is this is a question they ask people all around the world: what do you expect markets to return? In the US, it was 17% a year, which, if you know your market history, stocks, let's round up and be super, super, super generous. That's 10%. Okay, so you're almost double. If you compounded 17%, you quickly become one of the richest people in the world. So is it possible? Sure. Is it probable? No. But this is what happens. People get it exactly backwards, right? My favorite one to show is the AAI sentiment. And this isn't dunking on you guys, because I know you weren't participating in this survey. But AAI sentiment, 99, was the highest bullish people have ever been in the history of the survey, right? Bullish stocks. The single worst month in the entire history of the sample to be bullish stocks, people were most bullish, right? And it happens on the converse too. People got really bearish earlier this year. I think the bullish percent got down to the teens, or certainly in the 20s, but it might have been teens. Anyway, people love to get this wrong, and they love to extrapolate into the future that the good times will last forever and the bad times will never end, right? So, but often that's oops, went too fast. Here's a problem. US stocks, we love to talk about valuations. People, their brain starts to misfire when you talk about valuations, but it's a pretty blunt tool, but it's a pretty useful tool, not for the way most people want to use it. They want to use it for, hey, I want to be able to pick the exact top. I want to pick the exact bottom of markets so I can be a genius. I want to be Nostradamus, right? We often say it's better to be Rip Van Winkle than Nostradamus. But this is US stocks 10-year P ratio. People call it the Shiller Cape ratio, going back forever, longer than any of us were alive. The average historically is around 18. The average in low inflation times, so when you're hanging out in those low single-digit inflationary periods, let's call that, you're going to have a PE ratio of around 22. Now, if you look at this chart, it's been as low as 5 a couple times. Early 80s, remember the death of equities was super low. 1920s and after the Great Depression, super low. And then we had my favorite bubble, the internet bubble, hit 45, pretty awesome, right? And then it tanked all the way down, culminating in the financial crisis. How many of y'all were buying stocks hand over fist in March of 2009? I think we got in the low teens P ratio. My goodness, gone are those days. And then you've had this relentless march up over the past decade. And it hit, doesn't show it on this chart, I think it was intra-month, but it hit 40 on the PE ratio, kind of the end of last year. And then we've come off since then. And so we're down, let's call it around 30. What does it say? Yeah, 30, which historically has been very high. So stocks still looking expensive relative to history. And for those who followed me long enough, you know, kind of started my career pre-financial crisis talking about trend following. Our ETFs tend to focus, or our framework and how we manage strategies, 2 main pillars. The first being value or valuation, and the other being trend. Those are kind of yin and yang. They often look like cousins, right? But at times they can line up. And here's a chart of US stocks, S&P 500, SPY. What is this? Past 6 years, the black line. And the red line is this 10-month simple moving average? Yeah. So just a long-term trend following metric. And what we demonstrated in a paper, and this is an idea that's been around for well over 100 years, so nothing new, is that when the black line's above the red line, you're in an uptrend, and below you're in a downtrend. And historically, being above the red line, the returns are better. And when you're below the red line, the returns are worse. But more importantly, the volatility is much higher and you have larger drawdowns. Okay. Now, trend following is hard for a lot of people, right? And you can see why in this chart. End of 2015, end of 2018, COVID, you got these kind of whipsaws, right? Where it looked like, oh, zombie apocalypse 2020, fastest ever from all-time high to bear market. Looks like stocks are going down 90% as we all start to eat each other in the streets. Well, turns out it romped right back up to all-time highs. And so people struggle with trend following for many reasons. The biggest is A, you look different, but B, you're often wrong. What's worse than being different is being different and wrong, right? We don't like to stand out from a crowd as human beings. And so trend following for many people is hard emotionally, psychologically. Now, buy and hold is also hard for separate reasons, and we can come back to that. But this chart shows a simple where we are now, which is very clearly in a downtrend. Despite our romp up on Friday, U.S. stocks are still currently in a downtrend. So why does that matter? Does it matter? Well, again, I'm a very sophisticated quant, so I use fire and poo emojis to get my point across. By the way, I have a 5-year-old, so maybe this is an influence. When I go on CNBC or Bloomberg, to make it a little more interesting for him, or for me too, I let him pick a word of the day. And so I have to work that word into the conversation, which is also often quite challenging. Some of them, he's 5 years old, so it's words like ninja, fart, stuff like that. Today I said, Anton is my son's name. I said, Anton, what can I work into this webinar I'm doing? He said, what's a webinar? I said, it's like TV on your computer. Don't get distracted. Give me a word. He goes, all right, your word is, give me a word to use. I was like, all right, well, that's a little meta. Now you're just making it really complicated. Anyway, I worked in the poo emoji for him. Looking at U.S. stocks, you can simplify how to think about this in my mind by saying, okay, let's put U.S. stocks into 4 buckets. Are they in an uptrend or downtrend? Are they expensive or are they cheap? And historically, over the past 120 years, U.S. stocks, if you said, all right, They're in an uptrend and cheap. That's historically been the best bucket to be in. That's no surprise. That's what we would probably guess, right? That's my favorite investment, right? Is a cheap, hated investment that's like just entering an uptrend. Historically, that compounds at 17% per year. Amazing, right? What's interesting though, is the second best quadrant of the four is an expensive uptrend, meaning you have a market that's expensive, but it's continuing to go up. So think about the S&P for the last 5 years or so, right? It was an expensive market, but it kept going up. Now, the problem is when that flips to the worst quadrant, an expensive downtrend, you get basically nothing. You know, it's not -10 a year, but you're basically not getting rewarded for owning that asset. Historically, it's been 1% a year, which you'd probably be better off hanging out in something else. So that's where we are now, right? An expensive market in a downtrend. Here's the problem. So this chart is from a couple of my favorite professors. They wrote my favorite investing book. It's called Triumph of the Optimists. Now, it's super expensive. It's like $100 or something. So try to buy it used or get it at the library. There's a free update they publish yearly through Credit Suisse, I think. And it's called the Global Investment Returns Yearbook. They put out one every year. So there's like a dozen of these now. And it's chock full of information, historical returns, stocks and bonds and markets and factors and everything else. You could read them all and it's like getting an MBA in investing. Anyway, they looked at markets and they said, okay, well, you know, do stocks and bonds, how do they perform in different inflation or deflationary environments? And so this little square box line that kind of moves up from the left to the right, it shows different inflationary environments. So it goes from deflation to 0.5, 1.6, 2.7, 4.1, 7.4, 18, right? And what you can see, just a very basic trend of this is stocks and bonds, real returns. So that's returns after inflation, just kind of stair step down all the way to the right where they go negative. And here's the $1 million question is we're sitting in a world in the US currently of, let's call it 8% inflation. The CPI comes out on Tuesday, the next one. I think most people in the world are expecting that to come back down from 8 or 9 to 6.42 in the coming months. We did a podcast. If you haven't heard it, go download it today. It's super awesome with Cam Harvey and Rob Arnott. They make the case we may not have seen peak inflation yet in the US, which is crazy to think about, right? But why does that matter? Well, historically, stocks and bonds hate high inflation. And the kink comes somewhere, I don't know, let's call it after like 3 or 4%. Things get a lot worse because people are unwilling to pay these huge multiples on stocks when you have high inflation, which is why everyone's always focused on inflation. Well, and this is something, to be clear, most of us haven't seen in our investing career. Some of y'all old gray hairs, no hairs maybe have remembered 15% mortgages and stuff like that. I was chatting with my father-in-law the other day, and we were kind of moaning about our 5% mortgage or whatever it was. And he's like, you kids these days, you know, right? Like, you guys crazy. He's like, I remember my first mortgage was like 15 or 20% or something. He's like, get out of here. But my point being is that often in markets, you see environments that many of the participants currently involved hadn't seen in their career. And that's when everyone gets kind of surprised, right? So global financial crisis was one of those markets where kind of everything went down except for bonds, which was something a lot of participants hadn't really seen in a really long time. Anyway, markets hate inflation. And so this is probably my least popular tweet of the year. And you can see in this tweet, it offers no opinions. It is simply fact-based, but it's Twitter, it's social media, so people go crazy, right? And what I said, and I'm not the originator of this idea. There's many others who have done this work, and they all confirm. So before you lose your mind about this, just realize it's pretty well established that if you plot out U.S. stocks and returns and the multiples people are willing to pay, you can bucket them. So remember, 10-year P ratio around 18 historically. Low inflation, let's call it low 20s, 22. But when the P ratio gets up above 4, and particularly up above 7, which is where we are now, the historical multiple people are willing to pay for US stocks is low teens. Okay. We're at 40, or excuse me, we were at 40 when I did this. We're now at 30. So people are less, they get less angry about this tweet because markets have gone down since then, but we're now at 30. Okay. You guys can do the math, 30 to 12. It's a long way down. In fact, outside of the last year or two, the highest valuation ever awarded a US market with above 5% inflation is 23. So even if we just go back down to 23, that's what, let me do the math in public real quick. You know, that's 25% down from here. Not great, right? You know, it seems to me on the valuation side with inflation, the risk is to the downside, so, which is one of the reasons, if you look at the expensive stocks now in a downtrend, one of the reasons we may be in a downtrend, this may not be over. We'll see. Now, what do you do about it? Who cares? Let's say, you know what, Meb, I'm a stocks guy, stocks gal. I don't care. I can sit through it. I got an iron composition. These dips don't bother me. But if you think about what can you actually do, well, the problem with US S&P 500, it's market cap weighted. Market cap weighted, traditionally when markets get expensive, most of the market cap weight often is the most expensive. So US late 90s, US currently, Japan in the 80s, China and India in the mid 2000s. So where can you hide out? Well, particularly if inflation does stick around. So think 1970s, 1940s. We did a really fun podcast with Lynn Alden. Add that one to the list too, where she makes the case that this decade could resemble the 1940s closer than the 1970s. Being in this period of financial repression, meaning bond yields are way lower than inflation. So you're getting taxed essentially being a saver. And what worked in the 70s? Well, 70s were really tough for almost any asset, but it turns out what worked well, cheap stocks, right? Value investing worked well. You can see in this chart, the low PE did the best, expensive PE did the worst. In the last year or two, you've started to see that. Valuation has really started to outperform. The expensive stocks are starting to get crushed or have been crushed. Many of those are down 40, 60, 80, 90% already. Here's another chart from Research Affiliates. And what this shows is the y-axis, can't talk, need another sip coffee, hold on. And by the way, fire in any questions, you guys, if you got any. I'm just running through this, no problem. It's annualized inflation by decade on the left, and on the bottom, it's annualized value excess return. So value above the market. And as you can see, it's not a perfect line, scatter plot, but in general, as inflation goes up, you see the best returns for value. And again, the inflation, we're at the top of that axis, right? Axis, I can't talk today, right now. So we're right now at print, I think the last one was in the 8s. So we're at the very top, whether that sticks around, whatever. But you can see 1970s, 1940s, right? So value had a great run during that period. This is a really fun chart. I talked about this last year as my chart of the year. It may end up being the chart of the decade. And what Matthias did was he said, you know, if you look at the value factor, so cheap versus expensive, all the way back to 1926, all these squiggle lines are how that factor did historically. And we know with history that it tends to do well. Buying cheap versus buying expensive traditionally has done a good job. But what he found was interesting. He said, what was the worst year ever for value? It was 1999, which was then followed by the best year ever for value. Remember what I said at the beginning? The good times tend to follow the bad. And those that I was a senior in college, but I remember my professors trading stocks during engineering class, right? Like they would stop the class, go trade some, what we would have called meme stocks back then, right? Or some garbage.com or some CMGI, what else? Lucent Technologies, some of those names, Cisco. But so value crushed it in 2000 and 2001. Remember that small cap value outperformed large cap market cap weighted by 150 percentage points during that period, 2000, 2003. Well, guess what? 2020 was worse than 1999 for the value factor. Let that sink in. It was worse than the peak of the dot-com bubble. So what happened? Guess what? 2021 was great. It wasn't the best year, but it was great. 2022 is also shaping up to be great for value. It's a quite a bit of outperformance that's happening, and I expect this to continue not just this year, but potentially for the better part of this decade. And if you don't believe me, good. I don't care. My largest fund is a U.S. long only value fund. You don't have to pick mine. Pick another value fund. Go to Morningstar, throw the ticker in there. You can see, and you click on holdings, and you can see the value composite of the reading. So it says, hey, this is the price earnings. Here's the dividend yield. Here's the cash flow. And then compare it to something like SPY. And you'll be shocked to see just how much more expensive the broad market is than something like a value ETF. And here we are. Yeah, we're off to the romp in 2022. This is an update. This is in April, but I would expect this trend to continue. Right, one of the better years for value, and to follow going forward too. The crazy part is the value spread. So cheap versus expensive, almost any way you measure it, is still at or above all-time records. So despite the value outperformance, it's still a huge spread. And traditionally, things like value spreads mean revert, right? So you can see this chart, you can see where it spikes up in like 98, 99. It had spiked up in the financial crisis. And then now, right, this huge spread, it's the biggest it's ever been. This one is Toby, it's right down the road from me here in Los Angeles. It's wider than 2000 and 2009, which is a little crazy to think about. So this could say that value times, good times are ahead. Here's a chart. I don't want you guys to focus too much on this. A lot of numbers. You can look at it later. But what this shows from Value Stock Geek, the top table is the last 20 years in investing, and it shows Vanguard small cap value versus the S&P and the Qs. And Vanguard small cap value outperformed by a whopping 3 percentage points per year. That's a lot. Similar volatility, similar drawdown, although the Qs were worse. But if you look at it, it's a tale of 2 decades, right? You had a 2000 to 2010 where it creamed S&P by 9 percentage points and creamed the Qs. And then the next decade, it underperformed, right? Nothing really beat S&P and the Qs. And again, going back to the beginning of our talk, the good times often follow the bad, and nothing was better times than US stocks for the past decade. People were asking me about the books, by the way. The books that I've mentioned so far, Triumph of the Optimists by Dimson Marsh Staunton. The free version of that is the Global Investing Returns Yearbook, which you can Google. It's from Credit Suisse. GIRY, G-I-R-Y is the acronym. We did a podcast with Professor Dimson. You can look up. That's pretty awesome. But they also have some fun white papers where they talk about what are the returns of investing in wine and collectibles and stuff. So Stephen had asked this is from the podcast. This isn't from today, but he said, what's the name of the book that's out of print and costs thousands of dollars now? This is a preview of a podcast we have coming up where there's a famous old investing book called Margin of Safety by Seth Farman, who's a hedge fund manager based out of Boston, but it's out of print. And that book goes for $2,000 on eBay regularly. But in preparation for an interview I was doing with the head of Carlisle, should be out this week. It's a fun one. I found a copy of the book, but it was in China. So I bought it for $13. And we'll see when it shows up. If it's the actual book, somebody just scanned it in China, looked at the barcodes, like this is $13. Or, in which case it's worth $2,000. Or, it's a fake Chinese version, or it's in Chinese, or it's just like a printout PDF, or it just never shows up. We'll see. I'll update whenever I find it. But but you can find the books actually usually floating around for free on the interwebs. This is a fun recent paper that came out from Roboco. You can download it. It's in my Twitter feed, the actual link. But they talk about conservative investing, and they do it. This is a methodology of doing value investing. They have a similar spin to we do, which we use shareholder yield. Shareholder yield is looking at stocks. Some people call it net payout yield. We just call it shareholder yield. It's the stocks that pay out large dividends and stock buybacks cumulative. So it's crazy to me, and it makes no sense why anyone would ever focus just on dividends or just on share buybacks, right? It's the same thing. And there's many companies like Apple, which we held for almost a decade in our largest fund. We sold it earlier this year. I was a little sad to let it go, but the valuation had gone up so much. Apple's a great case study because they use both dividends and share buybacks. And you could have a scenario, and you have to include share issuance. So you could have a thing where a stock has, say, a 3% yield, and you're like, awesome, 3% yield, but they're issuing 5% of new shares per year. So you actually have a negative yield. Okay, so think about that. So you have to include both. Anyway, we have a suite of those. You can see the tickers next to me on my background, but SYLD, FYLD, EYLD are the three shareholder yield ETFs. But so that's our approach to value. We like that. But this recent report, they looked at stock returns going back to the 1800s. What a research project. Can you imagine trying to find all the data for that? They looked at 1,000 largest stocks, and they did a similar screen. They went low vol, shareholder yield, and slice of momentum, and had great performance. Now, what's interesting, and again, you guys can study this later, but the quick takeaway is, when did these quality value stocks outperform? And it was not during bull markets. The speculative stocks did better in bull markets. But in bear markets or in moderate markets, value, quality outperformed by a mile. And that shouldn't be like the biggest news to any of us here. That shouldn't be like a huge revelation. That's common sense. And that's what happens in every bear market we've been a part of, right? Like the tide goes out, everyone looks around like, oh, wow, so we shouldn't have been buying those stocks trading at 100 times revenue, right? That was crazy. So looking at this, if we have a bear market, if we go through one right now, if we don't rip right back up like we did in 2015 and in 2020, I think the value, the high quality, which, I mean, look, that's what you want in investing anyway. Like when did anyone like Warren Buffett say, you know what you want? You want the really expensive junk companies. Like, no, that doesn't make any sense, even in the good times. So, and I like this Jeremy Grantham. We've had him on the podcast a few times. They love to call him a uber bear doomer. And I don't think he is, honestly, because the vast majority of his portfolio is in venture capital and emerging markets. But I just thought this was a great quote where he said, you don't get rewarded for taking risk, which is, people love to repeat that. You get investing, you get rewarded for taking risk. He says, you get rewarded for buying cheap assets. And if the assets you bought got pushed up in price simply because they were risky, then you are not going to be rewarded for taking a risk. You're going to be punished for it. And I thought that's a thoughtful quote. So what do you do? All right, so US stocks look vulnerable. They're expensive in a downtrend, and inflation is high. And if you were to ask me over coffee, I'm drinking coffee now, if you're asking me at happy hour, again, we're going to be at this conference in Huntington Beach. If anybody's nearby next week, we're also based in LA. So if you're ever in LA, come say hi. We're doing surf lessons for free on Monday and Broncos happy hour Monday night. That's gonna be a fun day. And I'm doing a live podcast with Steve Romick from FPA Crescent. So if you're down there, come say hello. But all right, so US stocks look vulnerable. You can hide out in value if you're going to do stocks. But let's say stocks go down 60%. Okay, awful. One of the worst bear markets ever. Would I expect value stocks to, totally sail through that? Probably not, right? 2008, 2009 was a good example. Value got smashed just the same as the broad market. So you can't really count on that. So what do most people do? They count on US bonds. Here's the problem. I sound like a parrot here, but we had Antti Ilmanen on the podcast too. He's got a great new book. It's a little high level, but if you want to dig in, it's got a lot of charts. This is my favorite chart in the book. what this table is showing, and you can see me desecrating the book by highlighting it with a pen, was stock market drawdowns and length and duration. You can see some of these, 15, 20, 30%, no big deal. Then you see some haymakers in there, right? 52%, 50%, 84%, Great Depression. And then it shows like what helped during these periods. And you can see index put, that's buying puts. So obviously puts should help. We have a tail risk fund. Trend historically does help. Treasury, which is bonds, has helped a lot in the past 6 drawdowns. But look before that, that wasn't always the case. And I think there is a almost universal expectation that bonds will help you during a drawdown. And that's why 2022 is a surprise for many, but it shouldn't be. They're not guaranteed to help, right? And in many cases, they didn't really help at all. And actually, they hurt. So think about that. You can't count on bonds to save your hide, particularly when you started at almost 0 yield. The good news is now we're up to above 3%. So you got a lot more buffer than you did at 0. Gold's like your crazy cousin. You can't count on him. And the last one is quality. Buying what we were talking about earlier, good stocks that are not over leveraged in value. I'm going to skip over this if you want. This is another paper link. It talks about, again, trend following as a way to mitigate your portfolio losses. I don't know hardly anyone that invests in trend following. We have a trend following ETF that's doing just fine. It's not doing amazing, but it's doing just fine, better than our buy and hold stuff. And then puts, obviously puts, you can't say guaranteed in our world, but puts by definition are almost guaranteed, like an insurance vehicle, to do well when it hits the fan. And historically, they have done a good job. Looking at this chart again, you guys can spend time with this later. I don't want to spend too much time on it now. So we're getting near the end, closer to the end than the beginning. What do you kind of do from here on out? And I think one of the biggest mistakes people have, going back to our earlier poll, to just be honest with yourself, you ask yourself, do you have a written investing plan? And most people don't. 70% said no. And it doesn't have to be complicated. Your written investing plan could be, I invest half in stocks and bonds and rebalance once a year. That's it. Goodbye. But the problem with not having a plan, I'll give you another example, is I asked investors, I said, when you buy an investment, stock, mutual fund, trade, whatever, do you have sell criteria when you initiate the position? And almost everyone says no. Why is that a problem? It's a problem because I'm going to give you a piece of homework, everyone. Walk out to your garage after this, okay? And take a look around. And envision a scenario where, okay, just picture your garage being totally empty. And then me coming up to you saying, okay, will you go buy all the stuff you currently own in your garage? That leaf blower that doesn't work, but you'll fix one day. That children's desk, and that child is now 30 years old. That aquarium that you plan on using as for plants now, on and on, right? Car that doesn't even work. Would you go buy those things if you didn't own them? And the answer is always no, of course not. That's crazy. Why would I do that? Well, that's the same thing with your investments, is you have a different psychological, emotional attachment to something once you buy it than you did before. Okay, it doesn't matter if it's this awful coffee cup. I mean, we went through this experience. We just renovated our house, and it's pretty stressful to go line item by line item. Should we get rid of this? Keep it. Should we get rid of this? Keep it. Should we get rid of this? Keep it. I mean, for a while I said, look, why don't we just get rid of everything and start from scratch? And so just clean house, clean our mind. And that would have been a much easier psychological decision, I think, and which I had in retrospect. But think about that with the garage. Think about it with your portfolio. Pull out a piece of paper, blank, and write down your ideal portfolio if you could start today. Pull out your current portfolio, print it out, and look at all the garbage you have in there that's just been there because the phrase we like to use is mutual fund salad. The average financial advisor that's been in business over 20 years owns something like 200 different mutual funds for their clients. because they buy them, they put them away, they forget about them, right? And they just sit there. And next thing you know, you're sitting in this fund that costs 1.5% and it's just been a giant drag forever. And it's also tax inefficient. So in a year like this year, where everything is down, you have a huge gift. Guess what? You can go tax loss harvest the crap out of that portfolio if it's in a taxable account, right? You can just sell everything, book the loss, and rebuy what you want to buy. And I guarantee you, they're almost never the same, right? Like you look at what you own now and what you wish you owned, and almost never is it, oh yeah, I'm good. I'm happy with what I own. Usually it's a lot of legacy portfolios you just bought and I'm going to sell it when it gets back to even. I don't know. Maybe I'll sell it. It's too late to sell now. It's down 80%. Why sell it now, right? So I think that's a helpful starting point and way to think about going forward. What we didn't chat about today, which we can chat about after and in the Q&A, is foreign stocks. Foreign stocks are a lot cheaper. So if the US is at, let's call it a 30 PE, foreign developed is down near around that average. So it's high teens, and foreign emerging is low teens. There's some emerging market funds and ETFs out there that yield 7% right now, which is a far cry from what the US has. Emerging markets, I think, are screaming cheap. Anyway, all right, so let's talk about, what do we talk about today? Kept you guys for almost an hour monologuing. So start firing in some questions. I don't even see any questions yet, you guys.
There's a couple.
Let me, I'll hit that. I'm going to do the quick summary and then we'll hang out and I can answer questions. So the quick summary is the US stock market cap weighted. So when you say something like stocks, by the way, you can't, that's like saying dog, right? Like if you walk outside and you say, let's get a new dog, we're like, well, what do you want to get? You want to get a Labrador? Do you want to get a poodle? Do you want to get a Dachshund? Do you want to get a Beagle? They're not remotely the same, a Great Dane. So just saying US stocks doesn't really, I think, capture the opportunity set. So market cap weighted S&P 500 style investment is currently expensive, and it's in a downtrend, which historically has not been a warm and fuzzy place to be. So what do? You can certainly diversify. You can tilt towards value. I think that'll help, and it has helped the last 2 years. I think it could help for the better part of this decade. International, which we really wasn't the focus of today's talk, but I talk about a lot, is much cheaper. And I'm happy to chat about international if you guys want. Real assets like commodities, real estate, historically do a good job during inflationary times. Commodities are helping. REITs aren't doing much this year because they were kind of on the expensive side before this year, but they're looking a lot better. But at its core, and AI tends to be pretty good at this, crew, you still got to be mindful of expenses. You got to be mindful of costs, and most importantly, the most boring of all, but probably most impactful, be mindful of taxes. And then have a plan and stick to it. By the way, here's my Twitter handle, my email address. I will stick around for a little while and we can get into some more. The question about treasuries, how does it have a negative yield? Isn't it a safe investment? Well, those are two separate questions. We'll start with the negative yield. There was a certain percentage of the sovereign bonds around the world in the last couple of years that had negative yields. It was like a third of bonds around the world had a negative yield. And they didn't teach that to me in school when I was undergrad, right? But it has happened in the past. It's a bit unusual. And that really only helps in a possible scenario of a deflationary bust, where you have a very strong deflationary environment. But in general, no, that is not thoughtful to be buying things that yield negative 2%, right? It's like, why would you want to do that? That's crazy. And then you're starting to see a lot of investors. I mean, zero coupon bonds are down, I think, about half right now. So you own a 30-year bond, you're down a lot. We're near at or above historic drawdowns for many bonds. Now, historically, that's been a good buying opportunity. And the good news for the bond investors, we've now reset. You're now at a 3+% yield versus near zero. But it's certainly weird. Like it fits the category of weird. As far as being safe, here's a fun thought puzzle. Or to ask you guys, what is the, I think I could even find this by, let's see if I can pull this up with my, can you guys still see my, let's see. I'm gonna have to switch my new share to, oh yeah, desktop. All right, so this is my blog. There's my face again. This is a post we did in March of 2020. And I started with asking the question, what is the safest investment? So let's say you're like, you know what, Matt, I don't care about making 17% like these crazies. I don't want to be trading meme stocks. I just want to preserve my wealth. I don't want to go broke. I want to enjoy this lifestyle I've created. And I'm down 15% this year plus inflation. So I'm getting kind of hosed. But like, what's the safest investment? And you ask everyone. I'm extremely non-consensus here, so caveat. But if you ask every single person, what is the safest investment? They will tell you it's T-bills, short-term government bonds, money in the bank. And I'm here to tell you it's not. And so let me scroll down. So here's if you can see this, I said, let's say you're a conservative investor, you put all your money into short-term T-bills. How big of a loss did you have after inflation in the 20th century? And if you guys can see this, most people assume that it's, very small. And the answer is over half because of that inflation component, right? It's not the sharp crash like you have in stocks. It's the slow erosion where if you have inflation, like in the 40s or 70s, it's above bond yields. So let's say we continued right now with 8% inflation, 3% bond yields. You're losing 5% a year just by putting in T-bills, okay? So -5 a year. And that's terrible. So we ran a thought experiment where we said, okay, well, what if you want the safest investment? So avoiding a big loss, but also the worst 1-year return and volatility, all that. I said, well, US stocks don't help because they went down 80 at one point. Foreign stocks, 80, 10-year bonds, 60, foreign bonds, 80, gold, 85, right? Like there's nowhere safe. So then I said, okay, well, what if you do a diversified portfolio? And you guys can look at this later. It's a blog post. It's you end up with similar losses, similar positive months, similar worse months. So what you can do is you buy a global market portfolio, which essentially we have an ETF that does this, but it's global stocks, global bonds, global real assets. And then you can sprinkle in some cash too, so T-bills, and you can come up with essentially 2 percentage points higher yield than cash with similar risk numbers, actually better. So a lower drawdown, a similar worse 12 months. And you can kind of look at the chart here. This is on a monthly and yearly basis. The red line is if you mix owning assets with T-bills, and you can see it does a much better job. Now, how many people do you know that say, you know what, Meb, I invest all of my spare cash? No, nobody does, right? How many companies with their treasury assets, these giant companies, they put it on T-bills, right? And you can demonstrate, I can't say prove, but you can demonstrate historically it has been safer to invest a proportion of that safe assets in your after inflation return. So it's, I only know, so our company fully invests our balance sheet that we're not using for day-to-day transactions and bills. I fully invest my balance sheet personally. You see people talking about it when it comes to companies. There's only one other person I know that actually implements this, and he came down the same path that I did of the diagnosis, like T-bills aren't safe. He took a hard right when I went left on the prescription. So I said, you need to invest in a global portfolio of cash flow producing assets, right? That sounds great. Like, who wouldn't want that? Talmud was talking about this 2,000 years ago, right? So invest a third in land, business, and a third keep in reserve. So the other person I was talking about is Michael Saylor, and he just puts it all in Bitcoin, which is totally not, doesn't fit any of the criteria I was talking about, but at least he's thinking about it. So long-winded answer to your question, which is, we like to think in terms of historical evidence, and the historical evidence is not T-bills. It's you should invest it. So what else we got here? All right, so I see a few questions. Is gold a good investment? Why isn't it doing better? And also, how do you invest in commodities? Why isn't gold going up? I think it's a good question. Historically, gold does well when you have a negative yield curve, which most of the yield curves now are negative or are close. Gold traditionally does well when you have negative real rates, which we have now. So I would be surprised if it doesn't perform better over the next decade. We did a post recently applying our shareholder yield methodology to gold stocks and finds out it does well in gold stocks too. You can find that on the blog as a fun post. But if I had to guess, if you were saying, Meb, why hasn't gold done well thus far? I would say part of the air has been sucked out of the room by crypto. I think money that probably would have gone into gold, the Venn diagram overlap would probably be because some of that's gone into crypto assets, but that's a speculation. I don't know. And if crypto proves to be not a good diversifier during risk off periods, you may see some of that move to gold. I don't know. That would be my guess. But commodities, commodities are tough for a lot of people. Don't feel bad. It's tough for a lot of institutions too. They've struggled with commodity allocations. You can do commodities where you buy an ETF that does commodity futures. You can always look up on our website. I'm not going to mention specific ETFs, but you can look on our website and see which ones we own. All ETFs are updated daily with their holdings. And then same thing, you can buy gold ETFs too, or you could buy the natural resource commodity equities. So the stocks that do natural resources, and energy is a fun example because energy was a sector that everyone hated, threw away for garbage a couple years ago. Energy as a percentage of the S&P at one point in the 70s and 80s hit a third of the entire S&P, and it bottomed, I think, 2 years ago. Remember when oil quickly traded negative futures? Energy got down to like 2% of the S&P, and it used to be a third, and now it's up to like 5. So it's got a long way potentially to go from here. But commodities, to me, it doesn't have to be all of them, but I think it's all the portfolio. But I think this year is a good example of when and why it can help. All right, let me see what else we got here.
The first question.
Yeah.
Go ahead. The first question was about subscribing to your newsletter. How do they do it?
Easy. You can go to the Idea Farm or Cambria Investments and sign up. Those are two separate ones. So the Idea Farm is not, my day job related. It just sends you out research related each week on Sunday, I believe. And then Cambria Investments will give you, more related to our funds and what we're up to at Cambria. Both are free. All right, I'll just kind of run through a few of these questions, and y'all feel free to ask them as well. Do you favor currency hedging with international investments with the US dollar being so strong? This is rare for me, guys, because I feel like I'm usually pretty opinionated, but my answer to that is I'm agnostic. I think real currency returns are a wash over time, but they can obviously have very large moves in the short term. And so I think you pick your poison, one or the other. You either say, I'm going to hedge my currency returns, or I'm not, and then you just stick with it and it washes out. The third choice is you can implement currency trading strategies. That gets, I think, that's in the too hard pile for most of us. We used to have a currency strategies fund filed, and I was like, I don't think anyone understands currency trading. I think it's too complicated for most people. I actually wrote a book on it. It's archived somewhere in my my Dropbox years ago. We never published it, but Currencies are often confusing, I think, for many, but I think it's in a world of borders becoming increasingly meaningless. So we did a very non-consensus view post the other day. I'll screen share again real quick. And we were talking about international investing, which we're a huge proponent of. And I said, you know, everyone always asks me, Meb, you talk about foreign stocks, Why should I invest in foreign stocks? I got all my money in the US for these reasons. And I say, let's flip the script. Why should you invest in US stocks? And people are like, well, that's crazy. Obviously, I should invest in US stocks. It's rule of law, it's the best market, it's the biggest, yada, yada. I said, what if you didn't invest in US stocks? How would that change your returns historically? So here is an old, here is an old post from it's like 2 weeks old, that we did. And I said, let's run a fun experiment for the last 100 years. Let's look at the global market portfolio, where you own global stocks and bonds and real assets. But instead of owning global stocks, let's say you just own, so global is mostly US. Let's say you own no US stocks, all foreign stocks. So you own no US stocks in your allocation. These lines look near identical, at least to me. It makes about less than 0.5% difference per year. So it's a rounding error. If you started this study in 1950, it makes no difference. So the post-war period makes no difference if you own US stocks or not. And people always say, how can that be? That's crazy. US stocks have done better than foreign. It simply is the case. I make the case that the question, it should never be where when it comes to stocks, it should be what. So the decision to invest in, say, value, wherever that may be, is a much more impactful decision than investing in where, what countries and what stocks you should pick. Historically, it doesn't matter where. What does matter is what. And people always focus on the value side of the equation, where they say, oh, yeah, buying cheap stuff, and that's important. But it's equally as important to avoid the expensive, like to avoid doing the really dumb stuff. So avoid buying the US in the late 90s, avoid buying Japan in the 80s, avoid buying India and China in the mid 2000s, avoid, in my opinion, buying market cap weighted US now, because those are a drag on performance, these bubbles that go totally crazy and to the upside. So historically speaking, the US dollar and foreign, it's a wash, but to me, it's much more important to think in terms of what stocks, not where. All right, I'm going to keep cranking down these. Currency hedging, Bitcoin. I don't have a lot good to add about Bitcoin. We mentioned this isn't an investment advice, but one of my favorite things to look for during market sell-offs, we wrote about this in our during the pandemic, March 2020, we wrote an article called Investing in a Time of Coronavirus, and we talked about, you can find it on the blog. We talked about some things to think about, and often during dislocations, you see certain types of funds, closed-end funds, which, unlike an ETF, which should stick right around net asset value, closed-end funds can trade away from their net asset value. So for $100, you could be buying something for $50. It's an amazing type of trade. I don't like them in general as long-term investments because they tend to charge a lot for expense ratios. All 12 of our funds are cheaper in the category average, and we actually have a couple of our funds are the cheapest in the entire category, which is pretty cool. Closed-end funds often charge 1.5%, 2%. So I don't want to stick around for long. But during the financial crisis, and again during COVID, you had funds that were trading at 30, 50% discount to their net asset value. Bitcoin is a similar situation today. There is a closed-end fund that owns Bitcoin that I think is currently at about a third discount to net asset value. Again, it's expensive, so you don't want to own it for the next 10 years. That's a thoughtful way, in my opinion, of probably getting exposure. This is the least satisfying answer to a lot of people because they either want to hear put all your money in Bitcoin or none. But I always tell people when they're thinking about investment, I say, think about it in terms of the global market portfolio. And so crypto is like 0.5% of the global market portfolio right now. So if you got $100,000, you can put 500 into crypto. Nobody wants to hear that, right? They want to hear, I want to put it all in. But if crypto then goes up 100x, your $500 becomes a lot more. If it goes to zero, it's no big deal. That's the way I think about it. I think it's all the parts of the global market portfolio should be in your wheelhouse of potential. So farmland is one we talk a lot about on the podcast. It's kind of hard to allocate to, but we think there's a great long-term investment. We talk about startup investing a lot. All right, we did commodities, we did gold, we did, do I expect the current rising interest rate trend to be that long? I have no idea. Interest rate prediction is tough. I think my only short-term prediction is I would be surprised if inflation rips right back down to 3%. I think we could be here higher for longer, which is usually a painful place to be for traditional assets. It's hard to get exposure to factors besides small in value. Where do we get exposure? Well, obviously we run 12 funds and we love those funds dearly. In a world of 10,000 plus funds, there's certainly becoming more and more niche exposures you can get access to, and there's certainly no shortage of investing websites that will give you a lot of information. Morningstar, ETF.com, Betify, all these. We got a question about a specific one of our funds. Your GVAL has not performed well, even though value is in favor at the present time. That's true. In fact, GVAL, which is a fund that we manage, that is a global long-only stock fund. It invests in the cheapest third, is it third or quarter? I think it's quarter of countries in the world. So there's 45 roughly investable countries, and GVAL invests in the cheapest quartile. So the question is partially correct and partially wrong. It's correct in that GVAL has done poorly. It's by far our worst performing fund. It's just been in the dregs for forever. We actually have one of the highest rated ETF lineups in the entire industry, which is cool because we're small. And the definition of that is looking at firms that have at least 5 ETFs, Morningstar rated. We have I think it's top 3 highest rated lineup. So the good news is we have lots of funds that are doing great. But why is GVAL the worst? Value is in favor and it's not. So what do I mean by that? Value has done well relative to market cap weight in the US over the past year. Foreign versus US has not reverted yet. So the foreign spread of foreign assets, foreign developed, foreign emerging, individual countries has not reverted at all. I think potentially you have one of the biggest value spreads in history for foreign versus the US. And if you look at foreign versus the US, people don't know this, it's roughly a coin flip. In any given year, does foreign do better than the US? Okay. Since 2000, since the financial crisis, US has outperformed in 80% of all years. If you look the last 70 years of markets, US versus foreign, the US outperforms by 1% a year or something. All of that has come since the financial crisis. And part of that is all these markets were trading at low teen PE ratios after the financial crisis. The US then went from 12, 13, whatever it was, to 40. So multiple expansion. And part of that was justified. Part of it was better growth, better increasing dividends, et cetera. But foreign developed and emerging didn't. They didn't have that multiple expansion. So if you look at a long-term PE chart, it's like an alligator jaw that's just getting bigger and bigger. So I would have said this 2 years ago, though, 3 years ago. Foreign valuations are a blunt tool. Now, the good news is, like I mentioned earlier, you have some emerging market funds that straight up yield 7% right now. And I think, to me, that the small value trade in emerging markets is probably, if I could guess, going to be, if you said, Mev, you just got to focus on compounding the next decade, where would you want to be? I would want to be in emerging market value. I think the valuations there are exceptionally attractive. We actually profiled, most investing managers, I feel like they only want to talk about how great they are, how well they've done. And so we sent an email a year and a half ago called Totally Not Crushing It, where we profiled another one of our stinky funds at the time, which is a value and momentum strategy that hedges the total market, which, by the way, so what it does is it buys 100 stocks with good value momentum characteristics, then it hedges it with futures. So it could be 25, 50, 75, 100% hedged based on how expensive the market is and the trend of the market. And right now it's 100% hedged. It's as bearish as it can be, right? It's having a great year. It's up on the year, but it was horrific from like 2015 to 2020. I mean, it was one of the worst funds in the world. And so we wrote an article called Totally Not Crushing It. And we talked about, said, look, what should your time horizon be? And most people, it's, a quarter, 1 to 3 years, right? They look at an investment and say, I'm going to evaluate this manager. And many of you who listen to podcasts have heard me say this before, but people used to come up to me, cocktail hour, and say, Meb, I bought your investment. Let's use GVal because it's doing terrible. And I say, Meb, I bought this. It's been a couple years. I love you. You're handsome. You're brilliant. Just kidding. I like you, so I'm willing to give you a little longer. How long should I give it? And I used to say 10 years. And they would kind of laugh and wait for me to correct it. And I say, no, I'm not kidding. Like, I'm serious. But now I actually say 20. And you can hear Bogle talk about this before he passed. We have a great quote from Ken French, professor, talking about this. Any investing asset or strategy or exposure can easily go, and Buffett is in this category. Look at Berkshire, look at his picks, can go well over a decade underperforming. And we have a lot of Twitter threads on this, but most people want their returns. They want it right now, which is why they continually do stupid things. And so I think maybe we'll focus on our global value strategy, so we can hopefully get some good karma and it turns because it worked for our value and momentum one. But I think you're right, and I think usually the utmost disgust and nausea related to an investment, if you look at something that has done really poorly for a long time, to me is often more of a 180 curiosity of it being a right time to own it or buy it. We did an old post that looked at assets, industries, and sectors and how they performed after being down 60, 80, 90%. And usually it's a good time to close your eyes, hold your nose, and buy rather than the opposite. All right, we got anything more? China. Ooh. China is an interesting topic because it is a huge part and becoming huger of the global stock opportunity set. Many emerging market funds, if you buy your emerging market ETF from Vanguard or others, you're going to get like half China. And so I think the Russia situation for many was uncomfortable, but it wasn't that big of a deal from an investor standpoint because Russia is such a small percent of the global portfolio. You start to get some weirdness going on with China and Taiwan. That's a different situation because every pension, it was already like 95% of emerging market funds own Russia stocks. It's got to be close to 100% own China. And then also your broad-based stock market allocations. So it's a big, big input. China has been a great example of booms and busts for the past 20 years. If you look at valuations, China's been one of those that's gone completely crazy, bubble territory back in that 06, 07. You guys remember the BRICS? Everyone wanted the BRICS, Brazil, Russia, India, China. Total crazy. But also 3 times in the past 20 years has been low teens valuations, which is where it is now. The other 2 preceded huge runs up 50, 200% in Chinese stocks. So is it a good time to be buying Chinese stocks, or is there more downside to come? I don't know. Our value strategies had 0 to very little China exposure the past couple of years, and they've started to increase exposure in China this year. We'll see if that lasts. Who knows? I don't know, but it's a lot bigger topic than Russia was. What are the best resources for buying farmland? If you go to our YouTube channel, which is a good place where we have siloed podcasts. So a lot of them are audio only, but many of them are video now. But we segment them by topic. And one of the topics is probably natural resources and farmland. So we've probably done a dozen podcasts on farmland investing. So your choices are private funds. There's a couple public REITs. And then there's some platforms like Acre Trader and Farm Together where you can buy actual farms. I'm guessing none of you actually want to buy a farm and go work it like we do in Kansas. That's too much work. It's a big headache. But there's a lot of resources. We spent a lot of time on that topic. I love your idea farm posts and Twitter. What are your other favorite feeds for more education? You can look at who I follow. That's one. You could also, we have a Spotify playlist starting in 2017, 2018, 2019, 2020, 2021 that has the best investing podcasts each week. So there's hundreds at this point of the smartest investors in the world, and not just our podcast. It's 95% other people's podcasts. There is a ton of information there. So check that out. If you look at Spotify for the Idea Farm, it has all of those queued up. All right, that might be it on the questions. Oh, fixed income, can duration ladders often offer reasonable returns? I mean, the thing with fixed income, it's easy. It's like a 95% correlation. Your returns are just going to be your starting yield. So if you're at a 3% starting yield, 10 years from now, you probably got a 3% return per year. The big lever, of course, is what was inflation. If inflation's 1%, good for you. You got 2% real returns. If inflation's 5%, you lost 2% a year. And that's always been the problem with fixed income for the past 200 years, is that you know what you're going to get, you just don't know relative to what, right? Relative to what is the inflation. And so I think bonds still play a role in portfolios. I think they're particularly still can be a good hedge during crisis and deflationary environments, which 2008, 2009 was. But if you're looking to build wealth and complement it with the rest of the portfolio, I think you still need to own global stocks. Ideally, I like value, but also real assets like commodities and REITs too. All right, you guys, last chance to ask some quick questions before I release you into your afternoon. Saturday afternoon here in Los Angeles. It rained yesterday, which is like Armageddon. Looks like I've exhausted everyone. Well, look, guys, if you have any follow-ups, you can email me always. If you find me in person, say hi. I'll buy you a coffee or a beverage or food. Type REITs to own. Oh, type of REITs to own. I thought you meant like actually type in, Meb, what REIT should I own? Well, we manage a REIT ETF that we're probably the only people crazy enough to launch in a pandemic. You can see it over here, BLDG. You know, one of the things we do when we launch funds, by the way, is we try to launch funds that only either don't exist or we think we can do, quote, much better or much cheaper. And in a world of 10,000 plus funds, you're like, how is that even, how are there no funds that don't exist? And actually, we think there's a lot. In the case of real estate, almost all of the real estate REIT ETFs are just market cap weighted. And again, market cap weighting is fine, but the problem with it, particularly during bubbles, is it overexposes you to the expensive stuff. And same thing with the stock index like the S&P 500. So historically, tilting a little bit towards value and quality, which is what we do in this ETF, we go global as well, is a better approach, we think, than market cap weighting. Now, I think it only adds like a percent or two of returns. I'm not one of these people that says our ETFs are going to do 40% a year, which is very aggressive. But I think something like value, it's just a better mousetrap. So anything else? Someone was mentioning our tickers, fail and tail. We have a tail risk ETF, which we didn't talk about today, but it buys a bunch of puts on the US stock market. There's a foreign version, which is what fail is. But basically they're insurance vehicles, you know, they're meant to do well when it all hits the fan. People often will use them as a bond replacement because 90% of the portfolio is in bonds already. some people don't want to sell their stocks for taxable reasons, so they'll kind of sub this in. Some people want it as an all the time insurance, same as car or life insurance. And some people want to express a tactical view. So if you thought what I do in the beginning of this talk, that US stocks are expensive and in a downtrend, and you want to partially, hopefully protect, things like a tail risk strategy could work with the knowledge that over time it'll probably lose money. But when it hits the fan, it should do well. All right, I'm going to take a breath. I think that might be it, guys.
Well, thanks, Matt, very much for presenting to us today. We appreciate it.
Thank you all. Come say hi in Manhattan Beach anytime.
You bet.